All right, folks, moving right along. We're going to see if we can follow through on some of these things. We got Mike Faulkender, former Deputy Treasury Secretary, and Mr. Doug Holtz-Eakin, former CBO Director. Mike Faulkender, there you go. What was the line? Oil, petroleum products permeate the economy. You said it on this show about 4 years ago. Boy, did you turn out to be right. Now, where are we on this? We're down to, I'm going to call it 55 to 60, but it's going to fall to 50. If the president wants 50, he's going to get 50 at some point. What's that going to mean? I don't know, negative CPI prints. You tell me, what's it going to mean for the inflation rate? Because the flip side of that is faster economic growth.
That's right. We're going to get both of those, Larry.
Yeah,
because we're going to see with oil prices in the mid 50s, you're going to see the price of everything come down. Because as we've talked about all along, it's not just the cost of transportation borne by individuals, but it's also growing food. It's getting a product to market. Every part of our economy is impacted by it. And so you bring that down, couple that with the AI boom. Lower energy prices are going to allow us to unleash AI even faster. If I look at the productivity numbers that you talked about at the top of your show, they're really being driven by the, AI is a huge contributor to it. So and remember, where does real wage growth come from? It comes from improvements in productivity. So if we simultaneously have massive productivity improvements while oil prices are coming down, those are the perfect ingredients for exactly the kind of blowout GDP growth that we ought to be able to see all throughout 2026. Couple that with the tax bill going into full effect, with all of the other deregulatory activities of this administration, and we have massive tailwinds going into a very strong 2026.
So well put. Doug Holtz-Eakin, I'm not saying you're going to have 5% plus growth forever or every quarter. I'm not saying that. But I am saying you have the capacity here. And off a productivity base that looks like a 4% trend line, okay? Maybe I'm wrong, but that's what it looks like on I don't just mean one quarter. I mean a whole bunch of quarters. I was talking to Conrad DeQuatros about this. Non-financial productivity looks like it's trending around 3 to 4% right now. So you get modest labor increases or other factors like lower energy prices. You're in business. I mean, maybe you can get a 5% year. Maybe it's going to be higher or lower. But nobody, the economics profession just doesn't, I don't read about it. It's like the greatest story never told. I mean, I've had Faulkender on this show. Time out for a year. He went in and ran the Treasury for Besant and got us a good tax cut bill. But he'd been saying this for years. We've been talking about it for years. Here it is. Here's Trump on the front pages of the Wall Street Journal saying maybe $50 a barrel, whatever. And it's not 80. It's not 100, Doug. I mean, this changes things fundamentally. And maybe the Cleveland Fed GDP now is a wake-up call today. I don't know.
Well, I'll say this, Larry. I mean, the economics profession has never been able to really put together a good way to forecast productivity growth. It just hasn't. That's the reality. But we do know that if you have taxes that are low and inefficient, if you have a contained regulatory state, if you have low oil prices, energy prices in general, these are the kinds of things that can allow technological innovation and business models to deliver high productivity growth. So you have to surround businesses with the right environment, and the deregulatory activities of this administration are unparalleled. They were in the first term. The energy price movements you've talked a lot about. You're getting the recipe for great productivity growth. Now, we've had some quarters of it. Will it persist? I don't know. We're not good at forecasting it, but I like what I see.
Yeah, the trend line looks great. Look, you got Scott Besant out in Minnesota speaking to the Minnesota Economics Club, which I hope is not a complete oxymoron, the Minnesota Economics Club, but we'll leave that alone for a minute. He's talking about increased business investment, CapEx in the jargon, Mike Faulkender. Full cost expensing, immediate full cost expensing, nearly full cost expensing for factories, 100% for research and development tax credits, machinery and equipment, all. That's a big thing. I mean, that's a Faulkender. That business is going to boom, and wages are going to boom, not only because they got new jobs and they're building factories and stuff, which is Trump's favorite, but also the inflation rate's coming down. You could have, just hold on one sec. You could have a quarter or two. I'm just saying, it's possible. A quarter or two of negative inflation. i.e. a little bit of deflation, like minus 1%. We've had 5 years of big inflation. You could have a negative quarter, too, couldn't you, Faulkender? That's on the scoreboard. It's possible. Economists don't say it, but it's possible. And that's going to give you 6-7% GDP. Think about it.
Absolutely, absolutely, Larry, because, think about the portion of the CPI number that comes from energy and then comes from food.
Yes.
Both of those are going to come down. We already know the rent numbers. If you go look at surveys of where rents are going, we know that they're actually declining. That's about a third of the CPI right there. So I just articulated somewhere between 40 and 50% of the contribution to the CPI calculation potentially having a negative number associated with it.
Wow.
Then you got the other pieces that are also going to be impacted by the deregulatory and some of the energy spillovers, and we absolutely could see the monthly number. It'll take us a while to get a 12-month number maybe that's negative, but we certainly could get a series of monthly numbers that have negative CPI when you aggregate all of those pieces together.
And it's a good thing because we've had all these years of high inflation. You know what I mean? It's like this is not like a 1930s deflation. We've had high inflation overshooting the target for so many years. It would be lovely to have a year or two where we were equal to 2% or less, a little bit of deflation. Doug Holtz-Eakin, I want to come to you. I don't know if you've been to Greenland, but I know you have an estimate of what it would cost to purchase Greenland. I believe the number is, I wake up in the morning shaving and I think Doug Holtz-Eakin said $200 billion, which is great. Now, like whether you buy it or you rent it or you make a deal. We already have security arrangements. Mr. Rubio's going over to talk to their foreign minister. I mean, I think something good's going to come from here. But there are a lot of benefits to Greenland. In other words, the press, the lefty media treats this like it's some, whack job, Trump, ridiculous idea. It's not. It's a strategic idea, and we can make a deal on this, right? Dollars and cents.
Yeah. Well, when the president started talking about buying it earlier in the year, we thought, okay, well, what'll it cost? And you can do the comparables two ways. One way is to look at the minerals there and look at the market value of the reserves. That's about $4.4 trillion. And if you look at the quickly economically recoverable, that's the $200 billion number. That's the cash flows you could capture. You'd be willing to pay for that. The other comparable, Larry, is the strategic location. And there, the best comparable is Iceland. So if you look at Iceland per acre and apply it to Greenland, you get to something like 2.8 trillion. It tells you the location matters. It tells you the minerals matter, and that's what you're negotiating over.
So, Doug, when you looked into all this, I mean, the Chinese this is a strategic property. It's not crazy. Russians up there, China's up there. I don't know who else is up there. You tell me, just give me another little bit about, because first of all, you're a sensible person and economist. You were the best CBO director in my lifetime. But the point is, this is very serious. The media should treat it seriously. This is very important strategically. When you talk about the Western Hemisphere, which is what Mr. Trump is defending, right? In some sense, this is the cap. This is the top. This is the top hat of the Western Hemisphere.
Yeah, this isn't complicated. Even I can figure it out. So, for a long time, you have to worry about the Russians coming out of the Baltic Sea into the North Atlantic. You have to be positioned to detect their movements and perhaps position personnel and equipment there. Now with the receding of the polar cap, you got to worry about the Chinese coming over the Arctic oceans and into the same North Atlantic. Greenland is the answer to that question, sort of in terms of geography. So it's not crazy at all. No,
great. Well put. Mike Faulkender, last one to you. Art Laffer put it best. If Abu Dhabi or some Persian Gulf wealth fund decided to spend $1 billion building new houses, we would love it. So can we stop picking on Steve Schwarzman and Blackstone? And by the way, they didn't even get that right. It's Blackstone, not BlackRock. That has nothing to do with housing. We can build new housing. If we get the greenies to build private housing instead of public housing on regulations, if we have stronger economies so people have the income to buy. Why pick on these on REITs and things of that? So I don't understand that, Mike Faulkender.
Yeah, Larry, the way that we need to fix housing is by fixing the local zoning and permitting issues. It is not an issue of corporations building
Yes.
single-family rental facilities. So, you know, I'm pretty strongly aligned with the administration on doing something about housing supply, but restricting the ability of corporate money to fund single housing rental units, I think, is a mistake.
Yeah, I couldn't agree more. It just.
Amen.
It's just, I mean, it's just, let's not meddle. Let's go to fundamentals. If you're growing the economy, people are working, income's going up, right? After-tax income's going up. People are working. You'll afford. You'll even get a break on lower interest rates, right? If the positive oil shock kicks in, you're going to get lower interest rates. That's good for mortgages. Let's stay with the fundamentals and not meddle around. Mike Faulkender, thank you. Douglas Holtz-Eakin, thank you ever so much. You're both terrific.